Welcome to video number 3 in our series of financial literacy terms and concepts. This time we're discussing terms that are related to investing. I'm Coach Troy from the Metro Lutheran Ministry Financial Opportunity Center, or FOC. And today we're going to go over another 10 terms that many people don't understand as well as they should. Now, we often hear the first two phrases on the news, but many people get them confused. The first is a bull market. Now, a bull market is just a simple term used to describe the stock market. It means that stock prices are generally moving up, and it's considered to be a sign of a healthy and growing economy. On the other side of the scale is a bear market. A bear market is marked by stocks trending downward or losing value. This is a sign of a weakening economy. Commodities is a phrase that you'll hear as well. This refers to essential goods that are often used in the production of other things. These are the elemental parts, if you will, of our production of anything. Examples would be iron, crude oil, gold, wheat, and even soybeans. These and similar type products are lumped together under the term commodities. Now, investment sectors is a word that sounds more complicated than it is. It's a very fancy sounding term, but it's a very simple concept. An investment sector is simply a group of similar type products or services that are lumped into one category. The energy sector might contain all businesses involved with oil and gas, but it would also contain businesses that create solar power or wind power. Most investors use the concept of investment sectors to balance out their investments, as it could be a dangerous thing to invest solely in one area. Imagine if all of your money had been in the travel sector during the COVID-19 outbreak. Risk tolerance. This phrase simply refers to how willing you are, as an investor, to risk losing your investment. The safe investments, like bonds, are pretty much guaranteed to make money, although not a lot of money. Buying shares of a new tech company could make you a lot of money if it's a successful company, or it could cause you to lose your investment if it fails. The amount of risk you are willing to take is called your risk tolerance. It helps to determine what types of investments you should be willing to make. Growth. In the financial world, the word growth is usually used in conjunction with the word stocks. So growth stocks are generally those that have a good track record of making steady growth over time. As the graphic on the left shows, however, they do have dips and dives throughout their investment cycle. If they're classified as growth stocks, however, they are a pretty good bet to over time trend upwards, but it's not guaranteed. Now, aggressive growth. This is a stock strategy of investing in stocks that have a very high potential for growth. On the other hand, they're also more likely than other stocks to fail spectacularly. So, if, to borrow from a previous term, if you have a high risk tolerance, in other words, if you could afford to lose that money, an aggressive growth stock may be right for you. Our next term is leverage. Much as in physics, leverage means to use something to move something larger. In this case, leverage means to use borrowed money to purchase more of a stock. This lets you afford more shares of the stock that you could have bought using your own money. Now, if you sell the stock, you're going to have to pay off the borrowed amount of money first. But then any profit you made on all of the stock that you bought is yours to keep. The danger with using leverage to buy stocks is that if the price drops below what you paid for it, you now owe money for something that is worth less than what you paid for it. Number 11 for my slides and number 9 for our word is ROI, or return on investment, sometimes called return on interest. This concept just refers to figuring out how much money you're getting back for the money you invest. For example, if you purchase a house for $100,000 and then turn it around and sell it for $110,000, you would have had a return on your investment of 10%. This concept allows you to compare the rates of return on your investments and allows you to compare them apples to apples. Therefore, you could put more money on what you are doing that is giving you a greater ROI and move money away from the ones with lower ROI. Volatility. This term means pretty much the same thing in any context. In the financial world, it refers to the amount of change in a stock's price, how it fluctuates between the highs and the lows. The more a stock fluctuates, the more potential there is for the price to go up and stay up. Of course, the flip side is true as well. A very volatile stock could just as easily go down and stay down. A stock that has high volatility is not a stock for the faint of heart, because it could look on Monday as if you had a lot of money, and by Friday it could appear that you were broke because of how the price fluctuates. Now, this concludes our third video on vocabulary and concepts of financial literacy that you probably missed in high school. Be sure to check out our other videos. Check us out on Facebook, YouTube, and Twitter. And as always, please remember to feed the pig.